I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. Alex, we got Brad on the line. What do you want to ask him?
How do you scale? How are you scaling up from here?
Yeah, that's a really good question, because if you scale in the wrong direction or with the wrong asset or with the wrong team or the wrong business model, then it's just, it's a recipe for disaster. So first of all, finding that correct model. Real estate investing, if you want to scale, is all about the velocity of money. So figuring out a model that allows you to acquire an asset, provide some sort of value, whether that's flipping, renovating, repositioning, or developing, like what I'm doing, to build up that equity a lot quicker. And then you can sensibly take that money out. And it's not to say to over leverage yourself. Like most properties, we maintain 70% LTVs, but then redeploying that capital.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. It's another one of our Ask the Expert episodes. We've got two really great people on the line with us. We have Brad Cartier and Alex Mandaro with us today. So Brad, as is our tradition, our experienced investors always up first. So first of all, welcome to the show and thanks for coming on.
Yeah, thanks for having me, Brian. I really like this format, so I'm excited to see how it goes. Hey, Alex.
Hi, how's it going?
Good.
Yep. And Alex, welcome too, but we'll get to you a little later. Good having you as well. And I got to also say, nice meeting you. So
it's nice meeting you too. And it's a pleasure to be here.
All right. Thanks a lot. So Brad, let's talk about you first. Do us a favor. Tell us a little bit about yourself, your background, your history, and kind of what got you into this apartment investing business.
Yeah, sounds good. So I was a former government employee. I always knew that wasn't something I wanted to do long term. I always had an entrepreneurial bent, just didn't really know how to hone in on that a little bit better. So I met early on a partner of mine who's still a partner in my development company. About over 12 years ago, we bought our first rental property. And we just sold that last year. It turned out it was a terrible investment, but it sort of kickstarted the investing career. And that's when you get the education, right? It's you can only take so many classes. It's when you actually get out there and execute and learn by doing that you learn the best lessons. So we kept buying small condos. New build condos was our sweet spot for a while, just because it was super easy, very low maintenance. You had we call them condo boards here in Canada, HOAs in the US, that handled a lot of the maintenance. So we built up a nice small portfolio of those, and then we started learning about this thing called multifamily, and started looking a little bit more closely at it, realizing that we could scale a lot better and really optimize our returns by getting into the multifamily units. So we jumped in a couple of years later, bought a duplex, then we built a fourplex. Just recently, we built a 16 unit as well, and we're actively building sixplexes across different submarkets in the Ottawa, Canada region. So that's where we're at right now with our multifamily development. It's really just it's build from the ground up type strategy, as opposed to buying resale, and I can get into the reasons for that. And just separately from that, I'm a marketer. I do a number of different contracts for prop tech technology companies. So that's sort of my day job, and the development, the real estate development is sort of, you can call it a side gig, but it takes up a lot of my time as well.
Yeah. I think a lot of people who start with real estate as side gigs, a couple of things happen. They're happy with one or two or three or whatever their small number is. Or their side gig ends up turning into their main gig. I see that more often than not. Of course, I'm typically running the podcast where I'm looking for that type of people to come on. So maybe that's why I talk to that type of person more. But so let's rewind a little bit. A couple of things there that I didn't want to unpack. You said you started out in a government job. When did you decide to leave that government job, and what did your portfolio look like at the time?
Good question. I decided to leave very early on, but I stayed working for the paycheck so we
Right.
could build up the portfolio. I think by the time I left, we had about 30 units under management,
Okay.
give or take. So that was it got to the point where it was taking away from the real estate development side. So I was like, okay, now's the time to really double down on what's working for me and my family, and why we got into real estate to begin with. So that
Mhm.
was really the launching pad.
Okay. All right. So I like that answer. I mean, and really it was similar to what I did. I was in government as well, and um, gave myself a 3-year exit plan where I was getting that nice steady paycheck. And that's the nice thing about government jobs is um, they don't fire people very often, and you get that nice steady paycheck as long as the government is solvent and paying its bills. But um, so roughly 30 apartment, or not apartments, 30 units when you left the government job, and assume you haven't looked back.
Yeah, exactly. And we branched out into a few other asset classes like medium term and short term rentals. So in all now, the portfolio is about 100 plus units.
Okay, nice, nice. And I like that. I think there's a lot of wisdom in diversifying, and a lot of times when people look at diversification, you're looking at different, asset types inside of commercial real estate, but you've also got, different diversification based on the rental model. I mean, long-term versus, the medium term and short-term rentals all have a different risk and return profile. So now out of those, if you had to pick one, out of the type, let me back up a little bit. Out of the type of investments that you do, the ground up developments, the long-term, medium, short-term rentals, if you had to pick one as your favorite, what would it be?
Long-term multifamily development, hands down. It's scalable. The short-term and medium-term rentals can be very profitable, but operationally and logistically, they're very challenging.
Mhm.
And I'm like you, Brian. I want a little exposure to each, but really our focus, 80% on the multifamily, small multifamily development. We're not talking big, condo buildings, but max 16 units, and like I mentioned, our smallest is a duplex.
Okay. Now you mentioned earlier that you choose the development over buying existing. Can you go into why and what the dynamic is there that's different?
Yeah, for sure. So I'm thankful we did, but at the time it was out of necessity. We had a red hot market here in the Ottawa area, as most markets across North America now do. But this was way pre-pandemic, and the market was just going on fire. So, as most good real estate investors know, or savvy real estate investors know, you make your money when you buy.
Mhm.
And overpaying for an asset was really frustrating me. Bidding wars, I don't like. I don't want to be the 12th bid in. So
Yep.
we made a decision very early on. It's okay. It's going to be a little bit more complicated, but we're going to create our own value by buying underutilized land, rezone it where necessary, and build these small multifamily units. And it turned out to be one of the best models out there. And I can get into those reasons, but that's
Mhm.
sort of the instigator for that.
Now, I think a lot of it, and I've seen this as well. I mean, we have, my portfolio is 655 units, all in the Southeast. And, let me see if I'm hitting the mark. I mean, 3 years ago, we could buy existing multifamily at about 40 to 50,000 a door. And the development cost was around 100,000 a door. In the last 3 years, I've seen those numbers even out. So you say you make your money on your when you buy, and I 100% believe that. The basis in some areas is a lot lower on development now because of how the real estate market has appreciated. So, I mean, is that kind of what you're looking at as well up there in the Ottawa area?
Yeah, definitely pre-pandemic. It's sort of inverted here in Canada. It's if you're controlling your build, it's cheaper to build than to buy a resale, ironically, and you're getting a brand new product. So the refi after the completion is actually quite nice. But the pandemic hitting definitely put a strain on supply chains, and
Mhm.
lumber 4x'd over the course of a couple months, and it's been volatile ever since. So
Mhm.
that's definitely created some headwinds for development, but generally speaking, 100% agree with what you said.
Yeah. Yeah, and that's something I see a lot of people doing now is people who were, straight lace, multifamily value add guys. I don't know if that's straight laced or not, but who are just regular multifamily value add people in the last year or so have converted to developments, and part of it has to do with prices. And 100% understand what you're saying about the costs. I mean, the stuff that we bought, pre-pandemic, or even a year and a half ago, if you look at what we were budgeting per unit for our renovations, I mean, those numbers have gone up. If we're lucky, only by 20%, but some of them have gone up by quite a bit more than that. So we've had to make a lot of adjustments on our CapEx. Fortunately, the rent increases have been significant enough where it still makes sense to pay that price. Are you seeing something similar up in the Ottawa area? I mean, how is investing in Canada different from investing in the US? Do you have enough US assets to be able to make a good comparison?
Very few US assets, so wouldn't be able to make a huge comparison. I think that the biggest difference from what I can tell of speaking with investors down in the US is the regulatory system. It's a little bit more closed off here in Canada. A lot more local municipalities have a lot more say in what and where you build. The development fees tend to be quite a bit higher here as well. I think that's the bigger challenge versus some areas where there's very few zoning laws or any. Some states are upzoning. California just did the SB 9 upzone bill, so we don't really have that in Canada, but it's starting to change slowly because governments everywhere, I think, are realizing, like, everyone's screaming about a supply crisis and affordability crisis, and it's like, well, how are you going to get more supply unless you enable the private sector to build more? So how do we reduce that friction? It's the red tape and it's the development fees. So I think governments are wising up to that, but I think there's a bit more red tape up here in the north.
Yeah, it's interesting. I mean, the supply and the affordability problems are both very much related. I mean, if there's not enough supply out there, what is existing and what's out there is going to naturally become more expensive, and so they usually go hand in hand. And I think you're absolutely right. There's a lot of communities, even here in the U.S. I think different municipalities have different rules on zoning, but there's a lot of them that are finding that, hey, if for us to solve the problem, to solve the affordability problem, we need more supply. On the other end of the spectrum, you got a couple of municipalities that are trying to solve the affordability problem with rent control, and that doesn't seem to work very well. But doesn't work for investors either. But
yeah, and you see all these things about vacant taxes and foreign buyer taxes, and these are just band-aid solutions that aren't. It's not going to create more supply. It's just going to make things harder.
Yeah. Absolutely. So let's talk about one of the deals that you've done. If you can pick one and go into a little detail on how it worked out, and let's just go from there.
Yeah, for sure. So, I mean, the standard deal is one, we're halfway through it now. It's a sixplex we bought in a tertiary market around the Ottawa area. And we made a very distinct decision early on to focus on those secondary and tertiary markets for a variety of reasons. But one was we saw sort of the urban sprawl from the major centers going out to these areas. Land acquisition was much cheaper and labor was cheaper as well. So we have a sixplex that we're building on a main street in a small little community of about 20,000 where I live, actually, just outside of Ottawa. So again, the red hot housing market means that even when you're trying to buy vacant land, it could be a little competitive. So we look for the worst of the worst. We want a house that's falling apart, that no one wants, that that's been on the market for 180 days. So we found one of those. It's on about a half-acre lot on the main street. So we bought the property for $300,000 about a year ago. We've been going through all the rezoning processes now. We're still in the rezoning, and we've actually fast-tracked it. So that gives you an idea of how long this kind of thing takes. We've already started building. We were able to start the build. So the sixplex is under construction. We're doing just finishing up framing. Our cost to build are such that they're controlled because we always partner with the builders in our funds. So we have individual corporate funds that own these multifamily assets, and we have a few select builders who have raised their hands and said, hey, we would like to be equity owners in these projects.
Mhm.
So it actually gives us quite a bit of lift on the back end. We're not, paying the lift that a traditional builder would charge, 20%. So we were able to keep our cost per square foot relatively low.
Mhm.
In this case, we're hovering around 200 bucks per square foot for construction costs. And then when we're done, which we have done in the past, we get those prime rents because it's a new build.
Yeah.
And then we'll lock in a traditional longer term mortgage through CMHC, which is the government-backed mortgage insurer here in Canada.
Mhm.
They do up to 85% loan to value, very low interest rates. Even with interest rates going up, these are quite low. And then we're able to pull out all of our capital that we initially put in for acquisition and soft costs and development fees and redeploy that to the next project.
Nice, nice. So I like a lot of things about that. I mean, first of all, finding the property that nobody else wants, single family home on a half acre. I think that's brilliant. Now in this case that you talked about, did you guys end up demoing the single family home?
Yeah.
All right. I may have missed that when you were talking, but so you took the single family home out and then put the sixplex on the half acre.
Yeah, and early on, Brian, we tried to mitigate our risk by keeping tenants in those homes, but to be honest with you, they're unsafe. They're not something that I would want to live in or want anyone else to live in, to be frank. So after the first couple, we realized let's just get them vacant immediately.
Yeah.
Yeah, even though there's a little bit more cost for holding that asset if we're not getting the rent.
Yeah. Yeah. And I'm assuming what rents are. If it takes, a year or two to it probably takes longer than a year or two. If it takes a couple of years to do the whole development and the build, the cost comparison, what you're getting in that rent compared to the overall build is probably a couple of drops in a bucket.
Yeah, exactly. 100%.
All right. Makes sense. Makes sense. Well, I like the idea. I love the plan. I mean, you're basically getting all your money out in each one and able to move on to the next one and just rinse and repeat the entire process. So now one thing about the builders, I've heard some developers go back and forth on the philosophy of partnering with builders. Have you seen any downside to partnering with the builders, or have you had any experiences where that make you think twice about that? 'Cause I've heard a couple of developers talk about partnering with builders and giving them equity has sometimes not worked out when the builder hasn't performed. How do you work through that?
Yeah, I mean, there's definitely downsides to it, and sometimes it requires some very tough discussions early on. But we have about 3 builders that we go back to over and over again, so we have that relationship with them. But early on, it was definitely a big risk on our part to partner with them. We've never had issues, and I think there's a good reason why. I do know other development companies personally who have had issues, who don't like that model. They're willing to pay the premium and keep the equity themselves. They move a bit slower in that model, but at least it's a risk mitigator. You don't have another cook in the kitchen. We set expectations very clearly up front that the builder is responsible for the build, and after that, we have a whole property management arm that kicks in. And the biggest issues can arise after that first year once development's complete, where walls might start to move, or there might be some shoddy workmanship that the builder didn't catch from a sub trade or something like that, and all those can lead to some disagreements or tough discussions. But again, with level setting those up front, that we will have these discussions. Things always come up in development, as you know, that we'll work through those issues. And we have a pretty good lawyers as well who have shareholder agreements that we use. And so it's it could be a landmine, and it's not necessarily, I wouldn't suggest to, Alex, go out tomorrow and partner with a builder and, build a 12 unit right off the bat without testing out the relationship. So there is an evolution that we went through, and I don't want to make it sound like it's easy, because it's not.
Yeah. And there's a similar discussion with buying multifamily and partnering with the property managers. I know several people who've done it successfully, and I know people who've tried it and come back with horror stories. So I think I like the way you phrased it. It was a risk up front, and you knew you were taking that risk. It was a calculated risk. You did everything you could to mitigate it. You built some relations, and it's worked for you guys. So very much appreciate that. Now, real quick, switch gears here. I always like to talk about people's motivations, what really drives them to be successful in this and really anything. So what is your why?
That's a great question. It's my family. I have 4 young daughters at home and a lovely wife, and I just want to be able to have the flexibility, both professionally and financially, to spend as much time as I possibly can with them, sort of to take over my time. And as recovering government workers, Brian, I'm sure you can relate to this. Going into an office 9 to 5 in a gray cubicle, not necessarily something I want to continue doing. So the why early on was just to get out of that. Now the why is to really build this moat around the various businesses that I can, spend more time with them and involve them in the business. I'm very passionate about real estate education, personal finance education. So my oldest is 11 and she goes with me to properties, and she helps with a bunch of stuff. So really involving them in the business. And I'm not saying they have to ever work for me or for the company, but at least giving them that opportunity at a young age. That's really my why.
Yeah, I think the exposure to the young kids helps. And incidentally, I also have 4 daughters. I have a son too, but and speaking of involving, one of my daughters will most definitely hear this because she's the podcast editor too. But yeah, I think think in similar ways. I mean, I wanted to get out of the government job. Mine was military, so part of that government job included 6-8 months at a time, a long way away from home as well, which it adds up. It takes a toll. I think all that time away from home, you probably felt the same thing, whether it's a cubicle or whatnot, that time away from home starts adding up really, really quick.
Yeah, my last 6 years with the government was all away from home in different cities and internationally. So it got to be way too much, not only for me, but my wife primarily. She's juggling a job and raising four daughters. It's not sustainable.
There were definite times where, I know my wife felt like a single mother, and that's just not, looking back at it, I wish I would have realized earlier that the toll that it would have taken on my family, but
100%.
Too late for that.
Yep.
Anyway, last question for you. What's next?
What's next? Like I mentioned, I'm really passionate about education. So we've got the development company down. We've got some really good employees. I got some people who are helping enable me to do other things, whether it's strategic thinking or other things I'm more passionate about. And the one thing I'm really passionate about is education. So about 2 years ago, I started a free weekly newsletter for real estate entrepreneurs called Briefcase. You can find it at briefcase.email. No sales pitch here, just go sign up. We write about one topic related to real estate every week. We do a deep dive and we try to have some fun doing it. We try to make the writing, really accessible and fun and humorous. So that's really, I spend half a day a week writing that newsletter, and it's the highlight of my week. I have so much fun researching and writing it, and I have a team helping out as well. So that's what's next for me.
All right. So we'll put a link to that in the show notes. So if anybody's interested, briefcase.email, and just head to the show notes, tap and see what it's all about. All right. So another quick shifting gears, Alex, you've been waiting patiently on the sidelines for a bit. So, welcome to the show.
Thank you so much. This has really been a great conversation because I think a lot of times, I've looked at value add, buying existing and then the new development side. And I've always thought, well, the new development is something that it's going to be 20, 30 years in the future for me when, that makes financial sense. But I've actually learned a lot in the past, 10 minutes about things that I never even had a clue on.
Yeah. And it doesn't have to be later. One thing I'm very thankful for, when I got in the multifamily space, having conversations like this and being around the conversations like this helped me realize that it could be now if that's what you really want. I had a guy, after I told him what I wanted to do, and my initial strategy was, I had a handful of single family homes. I was going to cash them out. I'd owned them for about a decade each, and so I had 6 figures equity in each one of them. I was going to cash them out, and I was going to go buy myself an 8-plex. I was really excited about that idea. And the guy put his hand on my shoulder and he's like, "Hey, Brian, you say you want to get into the 100-unit plus management." He's like, "Don't get into the 8-plex." He's like, "Just focus on what you want and go straight there." So anyway, just passing on some advice that really, really helped me a couple of years back. If the development's what you want to get into, don't wait. But that said, Alex, tell us a little bit about yourself.
Well, I think this is going to be pretty short because as you can probably tell, I'm pretty young. I am very new to my commercial real estate journey. I've started maybe 8 months ago, just soaking up knowledge. And I think that, I've always wanted to be in real estate. I don't know why, but since I was a kid, I've always thought of the idea of owning a property is really cool. And so about a year ago, I started picking up books and stuff because I'm a reader, listening to podcasts. And eventually I started to learn about syndication, like multifamily syndication. And that really spoke to me. And so over time, I actually joined Michael Blanc's mentorship program. And so I'm currently enrolled in that. And so it's really been a process of just learning and meeting new people and soaking up as much information as possible.
Yeah. I think I went the same route. That may have been where we connected. I don't remember, but I do hop in his networks. Don't tell him this, but when I'm looking for podcast guests, I'll hop into his networks again. But
yeah, that's definitely where you found me.
Yeah. Are you going to be at Dealmaker Live this year?
I am going to be at Dealmaker Live. And I just found out 2 days ago, I got an email saying that I'm going to be one of the panelists.
Nice.
Which there's perks to being 18.
Yeah. 18, huh? Wow.
Yeah, I probably should have mentioned that.
Wow. I mean, you mentioned you were young, and I knew that you were young. I didn't, I was assuming, 20 something, but
that's good.
Awesome. So 18 and in Michael Blanc coaching, looking for your first deal. That is awesome. I very much wish that at 18, I had the presence of mind to jump into something like that. So let's talk about this. Not very normal for 18-year-olds to do what you're doing. What's your why? Why are you doing this?
Well, so I actually, a couple months ago, I took the time to write out my why statement. So I worked with a friend and we took hours, and there's a process behind it. And so we went through the process and I really discovered something that spoke to me. And my why statement is to lead others to freedom so that together we can positively impact our world. And I think that can take many different forms. And so for me, another thing I'm passionate about is education, not necessarily school education, but more just mass education where I can just teach people that I know or people that want to know what I know. And that's really what my end goal is just to educate people.
I love it. I think that's a great goal, helping other people out. But yeah, so 18-year-old panel. I'll see you at the panel on Michael Blanc then soon. That's going to be really, really cool. So yeah, I'm excited to get out there. Dallas is always fun. Well, that said, hey, Alex, we got Brad on the line. What do you want to ask him?
Yeah, I did have a couple of questions that I came prepared with. So I figured, let's do this.
Let's do those. Yeah. If you got
other
questions, I'm sure we can throw those in too. So just, hit your most important first and let's roll through them.
Absolutely. So I noticed, you said you've been trying to scale up, and you're at around 150 units under management, you said?
Yeah, around 100.
All right. So about where, how do you scale? How are you scaling up from here?
So that's a really good question, because if you scale in the wrong direction or with the wrong asset or with the wrong team or the wrong business model, then it's just, it's a recipe for disaster. So actually, Brian, I'd love to hear your perspective on this, but just from my perspective, and first of all, the fact that you're 18 is amazing. I started when I was 25. So you got 7 years head start on me. And I don't know, Brian, when you started, but it's awesome that you have the mindset that you have at that age. So congratulations on that. In terms of the scaling, it was really, first of all, finding that correct model. And the most valuable lesson I learned from the initial purchases I made in the condos is that I learned by doing, and I learned that buying condos en masse was not scalable. I mean, I could buy probably one every year, maybe every 2 years. They cash flow okay. There's no real equity out, no forced appreciation we can do. You're just sort of sitting there and waiting for the mortgage pay down and appreciation to go up before you can access that capital to redeploy it. So real estate investing, if you want to scale, is all about the velocity of money. So figuring out a model that allows you to acquire an asset, provide some sort of value, whether that's flipping, renovating, repositioning, or developing, like what I'm doing, to build up that equity a lot quicker. And then you can sensibly take that money out. And it's not to say to over leverage yourself. Like we always maintain, 85 in some properties. Most properties we maintain 70% LTVs, but then redeploying that capital. So first, scaling is finding that business model that speaks to you, and what's good for me and what's good for Brian might not necessarily be good for what's good for you. So that's one part of the equation. And I found, real estate development and multifamily to be a perfect marrying of that. And another one's the team. So, surrounding yourself with people, and, you're young, and you're going to these conferences, going to meetups, and finding people, like Brian said, just being in these types of conversations. It's not necessarily, there's a one roadmap to finding the right people and network and all that kind of stuff. It's just putting yourself out there, and you're going to get lucky. And it's like increasing that luck surface area as much as possible through education, through conferences, through meetups. Who knows what's going to, who's going to fall on your lap, who you're going to connect with, what coaches you're going to meet, what mentors you're going to meet. So it's really expanding that network as much as possible to help you to build that foundation that when you do find the right business model, you can scale that.
Yeah. Yeah. And I agree very much with everything he said. I mean, there's a book that I love the title. I haven't read it yet. It's called Nail It, Then Scale It, and that's kind of what you need to do. And that's pretty much what he said. You find the business model, you find what you want to do. In our case, it was, B and C class value add in the Southeast, so we're taking, apartments where we can buy for a little bit of a discount because of the condition, because of the operations, put in some capital dollars, and on the flip side, sell them for a lot more than, we bought them, sell them for a lot more than our basis is, right? So that was our model. And as far as scaling, it's just a matter of, looking at the basic level. It's a matter of looking at the repeatable tasks and making those repeatable tasks as easy as possible. All right. Whether that's getting somebody else to do it, or coming up with a way that you do it, or a form, or, a system. You build a system around everything that you do, and that's absolutely repeatable. So, the first time you do something, pay attention to, everything that you do, and reuse everything that you do on the second one. There's going to be some obviously modifications to it, but I'll give you an example. It doesn't apply to real estate. When I was 20, 22, 23, I was teaching college math, and you mentioned you like to teach, but the first time I taught a math class, I didn't keep any of my notes. And so the second time I taught that exact same college math class, I had to recreate everything. The third time I taught that math class, I had all my notes saved because I learned from the first one. But it's really the same concept. Is if you do it once, you really need to be able to rinse and repeat it a lot quicker the next time. And that's I think the nuts and bolts of scaling is figure out the tasks that are repeatable, that you're going to do over and over again, and figure out how to reduce the friction, make those quicker, and eventually find somebody else to do them.
Got it. I mean, I think that actually really helped, because what I really got from that was that scaling is not just, well, let me hire as many people as possible, because I'm not in a position where I can do that right now. And so seeing that it's more, okay, how do you create systems for tasks that are just the same day in, day out? Mm-hmm. And I think that's probably it sounds like a good model for getting those kind of in order.
Yeah.
You're lucky too, Alex. Yeah. You're lucky too, Alex, with, being the generation you are. It's sort of tech is just there and you guys know how to use it. I tend to fumble around it a little bit, but I'm getting a lot better. But software and automations and SOPs and all that kind of stuff is so much easier now than it was before. So the tools are out there to scale once you find that business model that you like. And it could be self-storage, it could be RV parks, it could be multifamily, it could be short-term rentals. I mean, whatever it is and whatever resonates for you, then you plug in that technical aspect to it. You're off to the races for scalability.
Absolutely.
Fantastic. All right. This is kind of my other main question. What has been your biggest challenge? But this is actually for both of you, but Brad, you can go first. What has been your biggest challenge in getting your real estate business to where it is today?
Ooh, biggest challenge. I guess I'll hit two of them kind of in order, and they're very related. I think my biggest challenge was believing that I could do it, and that was really it. Like I said, I spent many years, in the military. Before that, I was, going to school and I ended up being a math professor, but I wanted to, get a PhD and work at a university. 20 years of military experience, nothing related to real estate or multifamily, but it's where I found my passion lie. But the first big challenge was me believing that I could do it. And the conversation that I talked about earlier was actually at a Michael Blanc conference, guy putting his hand on my shoulder saying, don't even mess with those eightplexes. If you want to get into the hundreds, start there, and that's something that helped me overcome that challenge. Was, he helped me believe that I could do it. And then I think the second one, and this is something that everybody has to, if you want to scale, there's another part to it, and that's raising capital. You can't scale without money. The hardest part, the next big challenge for me was being able to find the money and then later attract the money. So.
All right.
Yeah, I think I never struggled with the mentality aspect of it, but the capital is definitely one of the biggest ones, especially when you're first starting out, because you have the mindset and the basic knowledge and the sweat equity ready to put into a project, but coming up with $200,000 or $300,000 on a whim is challenging when you're first starting out. So first starting out, it was the capital. As we started to grow, my biggest challenge personally was delegation and letting go of tasks. 2 years ago, if you looked at my to-do list every day, I'd have probably 30 things that I had to do that day related to the real estate business. And really I didn't even realize it. It took a business coach of mine to just sort of slap me around and say, what are you doing? Like, 90% of these things can be passed off to, a second in command or a general manager or admin assistant. And my mindset was just more the old school mentality. It's like, I'm going to do everything myself. No one else can do it better than I can. And I realized as soon as I started delegating those tasks that actually other people do the tasks way better than I do. And I wasn't nearly as sophisticated at some of those tasks as I thought. I mean, everyone has their strengths, right? So, whether it's tactical or strategic or, finances or, acquisitions or dealing with cities or whatever it is, everyone has their strengths. So figuring out what my strength was and then, delegating the rest to team members or partners. If you find a partner where you're both going to put in sweat equity, it's figuring out, who's doing what and who's good at what. As the two can be mutually exclusive.
Yeah. I love that answer, because that's something that I struggled with too. But that was a later on down the road one. But it's something that I still struggle with. I mean, there's a lot of things that I do on a daily basis that I've started realizing I need to stop. I need to stop doing that. I have a virtual assistant. I've got people who I'm paying to do certain tasks, but I've got a whole list of other things that I need to offload as well. So I love that answer.
That really was great, because I think it's also something that you have to think about ahead of time, because if you're in the trenches, right, and you're bogged down, it's a lot harder to find time to outsource that. But if you're thinking ahead of the time, you can say, okay, I can see this task getting more complicated in the future, or I'm going to have to do that task more. So let me see who I can put this on now in order to not worry about that later.
Yeah, absolutely. And I know you said earlier about not being in a position to hire employees, but my first hire was a VA from Kenya, Robert. He was amazing. It cost about $300 a month for, it wasn't full-time hours, it was part-time hours, but it was a very affordable option to take a lot of the logistical and research and data entry tasks off my plate. And I'm not saying to do that right off the bat, but don't shy away, after a few years to start looking into resources like that, because it really can, it'll improve your business dramatically, because it enables you to do the things that, are going to move the business along, as opposed to the tactical things in the business that you've done 1,000 times that really aren't going to move the needle, but they're going to keep the lights on, so they are important.
Right.
And this very much relates to your first question, about scaling. I mean, that there comes a point in time where the scaling is bringing in the employees and whatnot. But I think you mentioned one of the key things that a lot of people don't, is you have to be aware. Every once in a while, you got to take time and step back and look at, what's going on right now. And a lot of people kind of use the phrase working in the business versus working on the business. Make sure you're setting aside time, quarterly or monthly, to review your procedures, to review what's going on. And if you're doing that, you'll know when the right time is to start offloading a lot of these things.
Awesome. Thank you so much.
All right, we got time for one more question.
All right. Well, so actually, this is not really a me question. It's more just for you, Brad. Right now you're working on, 6 to 16 unit development. Do you ever see yourself going bigger?
Perhaps, but probably be as a passive investor if I did, not as a general partner or operator. I think it's similar in the US, but once you get above a certain size, there's a whole new set of standards that come into place in terms of building code and accessibility and all that kind of stuff. And I think we've just found this really cool niche of missing middle multifamily, anywhere from 2 to 12, 16 units was a bit high for missing middle, but, anywhere from 2 to 12, I'm going to stay in that market. And I think about it from a macroeconomic standpoint as well. We need a lot more supply, and a lot of, suburbanization is definitely a way to do that, just sprawling suburbs. I don't necessarily think it's the best answer. And I think a lot of, sophisticated, policymakers as well as developers are wising up to the missing middle, gentle densification that can happen within a city that already exists in some of these neighborhoods. So converting a single family home to a sixplex like we're doing. I think you're going to see a lot more of that, because people do want to live in the city. And I think that over the next 10 years that missing middle type market is actually going to be more profitable than those bigger developments.
Mm-hmm. Awesome. Great answer. And I'm looking at actually being on the buying end in the area that I'm in for the same reason. I think a lot of the larger assets go for higher prices per door when you start looking at stuff, so if you're looking at, the cost and your return on investment, there a lot of times are higher returns. The scalability is a little different. I mean, it's a lot easier to get to 100 units by buying 100 unit property than it is to buy, 16, 17, 6 unit properties. But I think that if you're doing things right, and if the area you're in supports it, buying those smaller stuff, you're going to make more money. You're going to make money faster. So, but everywhere is different. I mean, I know you're Florida, right? Yeah, Florida. You're Florida. He's Ottawa. I'm in Idaho. So the dynamics in each place might be slightly different. So not just might be, there definitely are. So that said, we are about out of time. So one last question for each of you. Brad, you get to go first. How can listeners learn more about you?
Just hit me up on LinkedIn, fire me an email, brad@briefcase.email. Check out the newsletter. That's all me. That's my personality. I respond to every response to those newsletters. So yeah.
All right, nice. And I'm typing that into the show notes right now, brad@briefcase.email. So anybody looking to connect with Brad, definitely do it. Reach out to him and check out that newsletter. Alex, same question for you. How can listeners learn more about you?
All right. I am I'm mainly on Instagram. That's where I do the most of my educating. I'm also on LinkedIn at Mandaro Alex. So my last name, first name. Mm-hmm. And then my company is rubiconproperties.com. So you can go there and learn a little bit more about what I do. And just mainly Instagram is where it's going to be at. That's where I post most of my content.
Awesome. Sounds good. And we got an Instagram profile ourselves. So when we release this, we'll definitely tag you, and everybody definitely check it out. I put at Mandaro Alex is your handle, right?
Yes.
All right. That'll be in the show notes for everybody. So, definitely take a look at that. All right. So thanks very much to both of you for coming on the show today. Very much appreciate your time.
Yeah, thank you
thanks
so much
for having us on, Brian. Appreciate it.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.